Now, in Kenya, concerns that the country is heading towards a bond default are ramping up. The shilling has taken a hit, dropping more than 3% in the past month, one of the worst performances globally. Yields on dollar bonds due 2028 climbed to 14.6%, on track for 14th consecutive day of increases. And the country has delayed paying civil wages amid financing constraints. Matt Kindiger, practice leader, Sub-Saharan Africa Frontier View, joins me to unpack this. Matt, good afternoon. It's always good to have your perspective on the program. Now, Kenya has a principal debt payment of $2 billion due next year, compared with foreign reserves of about $6.3 billion. How likely is it that Kenya will face some form of public debt distress this year?
Well, firstly, thank you for having me on the show today. So, certainly, we do expect to see Kenya's fiscal pressures become more pronounced over the coming year or so, and this is being caused by what we think is causing this debt distress is rising global and domestic interest rates, and this is being combined with shilling depreciation. So these two factors are making debt servicing costs escalate in Kenya. So the government is struggling to pay or service its debts affordably. And the government has also seen an increase in its public debt levels because over the last few years, it's had to bail out a few state-owned enterprises, including Kenya Airways and Kenya Power, for example. So in terms of whether we think there's going to be debt distress or even a default, the one country we could maybe compare Kenya to would be Ghana, which defaulted on its international debts a few months ago. Our base case view for the next 6 months is that there is unlikely to be a default for the time being. So 2023, we're a little bit more confident that there's unlikely to be a default. And this is for a couple of reasons. One is that the government has brought forward a number of new revenue collection measures. It is increasing taxes, and it has made a pretty clear commitment that it will be prioritizing debt servicing and payments on debt. And this will come at the cost of things like, as you have already mentioned, civil service wages. We're also expecting to see a very significant cutback in public investment in infrastructure, for example. So certainly there will be quite significant sacrifices to avoid a default this year. Next year, however, assuming the economy, well, if the economy doesn't pick up and doesn't accelerate, then a debt default is still possible in 2024, although still not our base case.
You talk about Kenya diversifying its revenue sources, but is that enough right now? Because I know that the World Bank and the IMF did project that with Africa, especially the vulnerable countries, less developed countries, are going to have a huge debt on their hands, a huge debt burden, and this because of the high interest rate environment that we find ourselves. How do you see this impacting Kenya and the revenue that you've mentioned? Is it able to match the high interest rates that is prevailing at the moment in terms of payment of their debt?
In terms of payment of debt, yes. So it is a very big question, and I think it's worth taking a step back and thinking about why the region and why many African countries are in this position. One is, as you've mentioned, interest rates are rising. Currencies have been under significant pressure. Many currencies have lost a lot of value, like the shilling against the dollar over the last 6 months or so. And many of these factors were not really anticipated, especially before the war in Ukraine had this effect on interest rates and inflation. So the question is, if interest rates remain elevated globally, so if the US Federal Reserve keeps interest rates elevated, which we expect it to do, then bond yields, pressure on currencies will remain high, and this will mean that governments will struggle to repay debts. The question is whether or not governments can mobilize new revenue-generating measures, so increasing taxes, increasing tax collection measures on the private sector. If that is effective, then we are likely to see most governments avoid default or increase their revenue base. But I would say there's a lot of uncertainty at the moment, and it also depends on what happens to economic growth, because if economic growth does not increase, then the size of the economy won't increase, and therefore tax revenue collection won't necessarily increase. So a lot hinges on whether or not countries like Kenya are able to accelerate growth and stimulate greater tax revenue collection over the next year or so.
We talked about the country's growth projection. How much of a squeeze will this impact have on the public finances, and how would that affect the growth projection you probably in front of you have mapped out for Kenya?
Yes, that's right. So I would say, well, firstly, we have downgraded our growth view for Kenya in 2023 and 2024. We've downgraded our growth view by about a percentage point. We were previously forecasting about 4.5% this year and 5.5% next year. That's more likely going to be about 3.6 this year and about 4.5% next year. So a fairly substantial downgrade, and public finances or squeezed public finances are a big contributor to this downgrade. And this is because over the last couple of years, we were expecting to see an acceleration in public investment, an increase in spending on things like the National Health Insurance Program in Kenya. But actually, we are certainly going to be seeing the government pulling back on these investments, pulling back on spending. And this does remove a very big source of demand from the economy. It also has secondary effects like civil service wages being delayed. That affects consumer spending in the market. So certainly, public finances being squeezed is a big contributor to this. But unfortunately, Kenya is also being battered by weaker investor sentiment, partly as a result of the social unrest that we've seen in the country over the last quarter or so. So we are expecting to see first quarter and second quarter GDP growth to be quite muted. And there's also rising inflation and the effects of the drought in the country. So there are a number of factors which are curtailing growth, but weak public finances certainly is one of the contributing factors.
I know that the Kenyan shilling has been taking a hit now. We've even seen that in their equities market. Their index is really down below the 120 mark that we're used to seeing. So but how will the shilling be affected by these pressures over the coming year? And we're looking at investors holding on to the Eurobond and the dollar, the yields rising on that. How does that affect the shilling? Because is it going to put more pressure on the shilling as we see now?
Yeah, so one message I would like to emphasize is that the shilling does face more downward pressure. Our view is that the shilling will likely end the year closer to 150 per dollar. And there is a scenario where if bond yields continue to rise and it looks like the government is struggling to service its debts, the shilling could end the year closer to 160 or 170 per dollar as well. So, the shilling has, as you mentioned earlier, has been one of the worst performing currencies against the dollar globally. This has partly been a result of a massive buildup of foreign currency shortages for the private sector in Kenya. Most of the clients that we've been speaking to over the last 6 months have said that they've really struggled to access foreign currency, to repatriate their earnings. And so this has kind of compounded the difficulties for the currency. Our view is that emerging market currencies in general will remain under quite a lot of pressure over the next year or so. The shilling is no exception. So certainly we would expect quite substantial downward pressure, continued depreciation of the currency, at least until late Q3 or Q4 this year.
Such a grim outlook, Matt. We hope for much better expectations, as you mentioned. Thank you so much, Matt Kindiger, practice leader, Sub-Saharan Africa Frontier View, for joining us on the program, sharing your perspective.
Thanks for having me today.